We're thrilled to have Matthew Pouncett, an equity analyst at Laurium Capital, here with us to share his expertise and insights on these topics. Hi Matt. So, to start, can you explain to us, what are hedge funds?
So the term hedge funds is quite a broad concept, and especially offshore, it can mean a wide variety of strategies, everything from macro funds, commodity funds, highly leveraged funds. In the SA context, when we refer to hedge funds, we're really talking about what we call the equity long-short category. And in fairness, compared to our offshore peers, we are fairly vanilla. So if I was to compare it to a traditional long-only fund in South Africa, it's probably best to do this with an example. A long-only fund will take 100 Rand and it'll fund the securities that they think are the most attractive, and they will buy these securities and hope to benefit from price appreciation. We do the same thing in a hedge fund, but in addition, we've got a set of tools that help us to both enhance return and mitigate risk. And the most important tool in that regard is the concept of shorting. Okay, shorting is when you borrow a share from an existing holder, you then sell that on the open market, you generate cash, and at a later date, you hope to buy back that share at a lower price and return it to the original owner. So we do that in addition to that long-only book of 100. So let's say I do 50 Rand of shorts, right? I'm now only 50 Rand exposed to the market. That's what you generally hear in hedge fund jargon as being our net exposure to the market. So by starting off with 100 Rand long and adding a 50 Rand short, I'm now reducing my market exposure. My net is only 50% of that of the traditional funds. That's where the risk mitigation comes in. But effectively now I've got 150 Rand of money-making opportunities, right? My long book and my short book could make return. To the extent that the short book underperforms cash, I'm making a return. To the extent that that short book's underperforming my long book, we're making a positive return. And that's where this idea of gross exposure comes in. Gross is the absolute value of those two books, the long book and the short book. And that's where the concept of leverage comes in. And that's really kind of why you get this dynamic where you can enhance return but also mitigate risk on the downside.
So Matt, can you give us a brief overview of the history of hedge funds in South Africa, especially compared to offshore? I know from our previous conversation, you mentioned that there might be an untapped potential in the South African industry.
So, yeah, interesting. I mean, in the South African context, hedge funds have been around for probably more than 20 years. Many people will be surprised to hear that that's kind of the history of the industry. At Laurium, we started in 2008. That's when our two founders, Murray Winkler and Gavin Forberg, started Laurium Capital, literally weeks before the Lehman crisis. So an interesting time to be born. So, we've got three funds, all have a track record longer than 10 years. So they've been tested through various market cycles. A big development in the SA industry was in 2015 when we were effectively brought under the CISCA regulatory framework. So CISCA is your typical unit trust that sits under that regulatory framework. And in 2015, a certain segment of hedge funds, which we call retail investor hedge funds, were included as part of that legislation. And what that means is actually hedge funds are widely available on investment platforms, LISPs. They're daily priced, they're daily traded, they're regulated. So that gross exposure that I mentioned earlier, that's capped at 200%. So again, quite vanilla and quite accessible to investors. Where offshore, they very much are the domain of kind of sophisticated investors used by your large institutional investors. So in terms of kind of coverage and acceptance, if you look globally, there's $4 trillion in hedge funds. In the South African context, we probably at about 100 billion Rand, so significantly smaller in that context. And we're very small in our local context as well. So despite the regulatory framework being very conducive, we're only about 100 billion Rand out of a CISCA industry, which is probably about 3 trillion. So still very, very small part of the investment landscape here. And I hope that is with time, with education, with investors seeing the benefits of hedge funds, that acceptance grows over time.
With that background in mind, why are hedge funds so appealing? Can you cover some of the primary benefits of investing into a hedge fund?
Sure. So really it comes down to this enhanced tool set that we have to both enhance return but mitigate and manage risks. So effectively, we're just going out every day and applying our investment process with far more tools at our disposal to really get the right dynamics. So we spoke about shorting and the benefits of that, and I'll elaborate on a little bit on that because that's quite key to understand. You know, by being able to short, we can vary our market exposure over time. A traditional long-only fund has to be kind of fully invested by mandate, so it'll experience the peaks and troughs and the volatility of the market. By shorting and by altering that net exposure that I spoke to about earlier, we can really kind of manage how aggressive or how defensive we are being at any given time. We always sit on liquidity, so we always have ready access to cash. So if there is a corporate action during the day, if there's a placement, if there's a sharp sell-off in a share price, we can action a buy call much more nimbly and much more quicker than a traditional long-only fund that will first have to make a sell decision before making a buy decision. So really the speed of execution and decision making is significantly better. We can take advantage of things like pair trades by shorting. So this is where you find two companies very much driven by the same macro factors, very exposed to the same risks, but where you identify a relative mispricing between the two companies. So let's say one is a bank and one is a retailer. They're going to be very exposed to the South African macro story, interest rates, what have you. But you think one is particularly expensive and you think the other one is particularly cheap. You can short the expensive share, buy the undervalued one, and if they were to converge, you will benefit and profit. But you've done so without taking on that macro risk. Another aspect which I can elaborate on is the ability to take advantage of corporate action and to create really the synthetic exposure that you really want in a certain given transaction. And that's probably best explained by an example, which I can elaborate on, which was the Anglo-American rump. But really, when you sort of take it down to that, it's effectively taking a team, taking an investment process and philosophy, by adding on these tools, by creating an unconstrained mandate, you've just got more breadth in which to execute.
You've touched on risk and you've touched on returns. And something that comes to mind is risk-adjusted returns. Now, that's a metric that I hear often when we speak about hedge funds. The fact that they're able to generate returns at a lower risk rating. Can you touch on how a hedge fund can do that and why risk-adjusted returns is an important measure when talking about hedge funds?
Sure, it's a great question. So return is obviously just the performance of the fund. It's important, but it kind of only tells one part of the story. Risk is really how are those returns achieved? And it's a very difficult thing to measure risk because risks don't always emerge. But the one that's typically used in the industry is this idea of volatility, or what the maths guys will call standard deviation. So how bumpy was that journey? How much did the fund go up and down and vary from month to month? That's what you call standard deviation or volatility. So when we talk risk-adjusted return, when what we're trying to achieve is effectively a higher return per unit of volatility. So i.e. your investor has had a more steady experience of that return over time relative to a traditional asset class. Why is it important? It's a great question because many people will say it doesn't really matter. Volatility doesn't matter. As long as it's not permanent capital loss, who really cares if I go up and down? But the truth is investor behavior plays a key role in staying invested. And the more volatile an investment is, or the extremes, the peaks and troughs that investors having to live through, the more likely they are to exit at the wrong time or entry at the wrong time. So by creating a smoother profile, your investors can stay invested for longer and make the right decisions ultimately. So that's what we're really trying to do by keeping that overall market exposure lower than a traditional fund. We're trying to create a smoother process. It's not to say that we don't have drawdowns or we don't experience any volatility. We do. We just hope to effectively get higher return per unit of volatility.
So I want to touch on a sensitive topic. when I look at the performance of Laurium Capital's hedge fund, for example, or any hedge fund for that matter, it's clear that they're performing well. But the sensitive topic I want to bring up is cost. We know that hedge funds do charge quite a bit more than your traditional funds. So how should an investor review these costs, and how do they come into play when determining the net return?
Sure. I mean, it's a pretty regular question, and a good one to answer. So the first point I'd make is that obviously when we show returns and we kind of show the value of the funds, that's all net of fees, both management and performance fees. The higher costs come in terms of the way the funds are structured. So we absolute return funds. We charge performance fees above cash hurdles. So when funds perform well and the absolute return is high, fees will tick up, and TRs, as they typically know them as total expense ratios, do lift. The important point I'd like to make is that it's very different to the long-only industry, which generally has a benchmark performance fee and has a rolling performance fee. So effectively, a long-only fund can produce negative absolute return and still charge performance fees. And because of the rolling nature of those performance fee calcs, they can often underperform a benchmark over a period of time, but still take performance fees. And that's where this concept of high watermarks in the hedge fund fee construct is very, very important. We basically measure over the life of the fund our highest point at which we took fees. And if we are below that, we're completely out of fee territory. We need to effectively get back to that high watermark and be cash, and then only then are we in fee territory. So you don't get this adverse experience where your investor has actually underperformed the hurdle, but just because you're rolling through peaks and troughs, you're going to be paying performance fees. So I think that's a very sort of unrecognized benefit of hedge funds, is this idea of the high watermark. And really the idea is high fees are paid when returns are high and beneficial to investors. And absolute, they're real. As someone once said, you can't eat, relative performance. So why are they higher? Really the complexity of running a hedge fund is very different to that of a long-only fund. So effectively, we're managing two books, a long book and a short book. So the investment demand, the demand on your investment team, substantially higher than traditional classes. But the most probably under-recognized one is the operational complexity. So this is managing prime broker relationships, treasury functions, because we're sitting on cash, margin requirements. So it's a significantly more operationally intensive asset class. And the third one is that it's just not as scalable as a long-only fund. Right, because we are very conscious of liquidity, especially on the short books, we can't scale the fund. So you won't find a 50 billion rand hedge fund like you will in a balanced fund category. You're very much capped between sort of 8 and 10 billion in the local industry in terms of how big your hedge fund can be, but yet you have all of this demand in terms of skills and human resources.
Great. So I want to make this a bit more tangible by bringing in a practical example. Can you run us through a practical example of a stock that you shorted that worked well for your fund?
Sure. So I mentioned it earlier, it was what we call the Anglo-American rump. What we mean by a rump trade. A rump trade is effectively where you have a listed company that in turn has listed subsidiary investments as well as unlisted investments. And really the rump of a company is that unlisted portion, right? So in the context of Anglo-American, they have investments in Kumba Iron Ore and Anglo Platinum, which are both listed on the JSE. And then they've got various interests in De Beers, in copper mines, iron ore. These are unlisted investments. And it's that component which we call the Anglo-American rump. So towards the end of 2023, Anglo-American came out with quite a severe production update. They cut a lot of their production targets, and the Anglo-American share price fell quite dramatically. So when we looked at this investment case, the most attractive part of it was the rump, right? Especially the copper assets. Copper is a commodity that's in high demand. There's structural support for it with the energy transition. It's a key part of that, and supply is very long dated and very limited. And effectively, that part of the of the Anglo-American stable was trading at a particularly cheap valuation, right? So we want access to that part of the investment case. In the loan-only context, you can't do that, right? You've got to buy Anglo-American. So then you'll be picking up exposure of Kumba iron ore, you'll be picking up Anglo-American platinum, and you're really getting quite a diluted exposure to this attractive rump asset. In a hedge fund context, we can go long Anglo-American, but we can actually short out the exposure of Kumba and Anglo-Plat. So what are we doing? We're effectively creating a long rump asset, really the most attractive part of the investment case. And subsequently, management came up with quite a sort of complex plan as to how they're going to unlock value, because it was clear that this was undervalued. So they announced a series of those to the markets. And interestingly enough, BHP subsequently came and made a bid for that rump asset. Now that bid failed because Anglo-American saw a lot of complexity in effectively creating that exposure for long-only investors. It's unbundling Anglo-American Plat, it's potentially selling Kumba. There's a lot of complexity in executing on that part of the plan. So that deal failed. But what it's catalyzed is Anglo-American will effectively do very much the same thing, but just over a longer period of time. So very much these things are real world, but as a hedge fund, we can kind of create these exposures ourselves.
You and I talked about this earlier before, and that's diversification. I mentioned that when I put a portfolio together for my clients, I want them to be diversified based on sectors. I don't want them to be over-invested in technology, for example, or in healthcare. I want them to have eggs all over, not all the eggs in one basket. And also especially with regards to asset classes. Now, when you look at a traditional investor's portfolio, how does bringing a hedge fund in add to this diversification?
So the important thing to understand about hedge funds is that by altering that net and gross exposure, we can very much create a very different risk-return dynamic. So if I look at our aggressive fund, for example, that runs relatively high net. So you will get a fair amount of market beta, what we call beta, the market experience, that will come through because of that high net exposure. So that's a great replacement for an equity allocation, for example. It won't necessarily provide massive diversification, right? Because it will pick up other factors that are existing in your portfolio. On the other end of that scale, it's something like the market neutral. Now that fund, as the name suggests, runs with very, very little net exposure, lower than 15% over time. So our long book and our short book are almost the same size. Now that will be very uncorrelated to everything else in the portfolio, because what determines its return from month to month is very much our own idiosyncratic positioning, how our longs and our shorts are performing relative to each other. So what we've actually experienced over time is that in months where the JSE has produced a negative return, that fund has actually had a positive number. So it doesn't have zero volatility, it does, but it's its own volatility profile. It's very uncorrelated to what's happening in greater asset classes.
Another important aspect to touch on is liquidity. You and I talked about this earlier, where I mentioned if we look at three aspects of investment: return on investment, taxation, and liquidity, you kind of have to choose between the three of them. You have to choose two out of the three. Now, how does liquidity affect a hedge fund from an investor's perspective? And do you guys have any liquidity constraints?
Yeah, it's an important question. As I said earlier, we're very vanilla in the SA context. So the instruments that we are buying, the instruments that we are shorting, are highly traded liquid securities on the JSE. So the liquidity of the portfolio, the underlying portfolio constituents, are all liquid. And in that sense, we can operate under the CISCA regulation of daily pricing, daily liquidity. That's not really an issue at all. The liquidity risk comes in on how we manage the short book. And that really talks to the size of the fund, like I mentioned earlier. So when you're a shorter company, you want to be able to cover that short within a very short trading time frame, 1 to 3 days, right? You don't want to spend hours and days and months buying back a share. So that is the key constraint on the size of a hedge fund, especially in the local context. But if we are managing that correctly, and we are sort of operating within our own kind of mandate constraints, the underlying portfolio is very, very liquid. So we could effectively unwind our long book and our short book within a very short space of time. So that differs to a lot of hedge funds overseas, which may have, monthly caps on redemption or yearly restrictions, because the underlying investments, some might be liquid, but some might be totally illiquid. So you saw that was, especially in the US, a lot of those funds went into private equity, for example. That's a very different type of animal than what we're dealing with locally.
Finally, looking to the future, what are the trends you see in the hedge fund industry, specifically local and then abroad?
So locally, what we'd like to see is kind of greater adoption. And I think we're getting there. I think investor education has certainly improved over the last few years. There are some certain regulatory hurdles. So, for example, Reg 28 funds can only really invest up to 10% of the fund in hedge funds with a 2.5% cap per fund. It makes it quite clunky for Reg 28 funds to really allocate to underlying managers. Unit trusts are still unable to buy a hedge fund. That's a constraint. So hopefully these kind of hurdles are mitigated and reduced over time, and that could lead to greater adoption of the industry. Globally, that really goes through peaks and troughs in different cycles. So globally, the hedge funds that are in demand are market neutral, low net funds, where guys are effectively trying to run with very little market exposure. That's kind of the main attraction or the main focus globally at the moment. But that really depends on the market cycle, and that will sort of go up and down. That hedge fund industry is very large and widely accepted. So that's more cyclical. In SA, I think it's more a base of just a slow and steady improvement in adoption that we hope is likely to come through.
Thanks again to Matt and Laurium Capital for making this interview possible. Stay tuned for more insightful interviews.